Hey guys, what's up and welcome back to EconRecaps. I hope everyone had a relaxing 4th of July, as today's episode unpacks a high-impact week of economic, corporate, and geopolitical developments. From Meta's aggressive AI push and a major trade deal with Vietnam, to the fallout of the healthcare sector and big moves from US banks, we've got a lot on our plates today. Starting off, Meta launched Meta Superintelligence Labs back in June, hoping to accelerate the development of its foundational AI model, Llama. For those of you who don't know, a foundational model is a large AI system trained on vast datasets that can be adapted for multiple downstream tasks without requiring new training data. Essentially, these models serve as a foundation for various AI applications, including language understanding, image generation, and reasoning. Examples include OpenAI's GPT series, Google's BERT series, and Meta's Llama models. Unlike narrow AI models designed for specific tasks, foundational models use transfer learning to apply knowledge across different domains. Since it costs roughly $500 million to train a new foundational model, any big company that can afford to do it now will be miles ahead of the competition. Investors were initially hesitant about how effective Meta would be at improving its already existing foundational model, as well as creating new foundational models. However, all fears were brushed away in July as the company began poaching AI heavyweights from OpenAI and Google, offering compensation packages ranging from 7 to 9 figures. Meta also restructured its AI division under new Chief AI Officer Alexander Wang, the founder of Scale AI. To support the transition, Meta invested $14.3 billion for a 49% non-voting stake in Scale AI, making it Meta's largest investment since acquiring WhatsApp. The partnership with Scale is expected to deepen Meta's access to high-quality training data and annotation services, which are critical for building large-scale foundational models. Shifting from tech to transportation, Tesla delivered 384,000 vehicles in Q2 2025, beating analyst expectations of around 360,000 units, but still down 13.5% year over year from Q2 2024. Production reached 410,000 vehicles last quarter, creating an inventory buildup of approximately 26,000 cars, which all need to be stored and maintained until they're finally delivered. The stock rose 5% on the better-than-expected results, though analysts remain cautious due to the ongoing brand damage linked to CEO Elon Musk's politics and stiff competition from Chinese rivals BYD. In the software space, Datadog, a leading cloud-based monitoring and analytics platform focused primarily on IT infrastructure, will be added to the S&P 500 index on July 9th. Replacing Juniper Networks after Hewlett-Packard Enterprises completed its $13.4 billion acquisition. Datadog shares surged 16% on the news, closing the week at $155 a share. Now, some of you may be thinking, who cares which index holds the stock? But when a company is added to the S&P 500, its stock experiences a short-term boost in price because all other indexes and ETFs that track the S&P 500 are required to buy shares of the newly included company. This surge of demand from passive investors and increased visibility typically drives the stock price higher around the time of the announcement. Though, research shows that the effect is usually temporary and fades within a couple weeks or months. However, this may be different as the inclusion follows strong Q1 results of $761.6 million in revenue, up 25% year over year. With a market cap of over $50 billion, it's clear the market is currently putting a lot of faith into the IT giant. Turning to financials, after passing the Fed's 2025 stress test, major US banks announced large-scale dividends and buybacks. All 22 tested banks showed solid capital reserves, allowing the Fed to feel comfortable with the financial stability of all major banks if a recession was slated to occur. These banks did not waste a second after the news came out, with JP Morgan raising its dividend to $1.50 a share and announcing a $50 billion share buyback. Goldman Sachs and Wells Fargo followed suit, with each company announcing a $40 billion share buyback, while Morgan Stanley authorized a $20 billion share repurchase plan. These results bolster confidence from investors as we head into the earnings season in the next couple weeks. In healthcare news, Centene withdrew its 2025 guidance on July 1st after revealing a $1.8 billion shortfall in its risk adjustment revenues for its ACA marketplace. This is linked primarily to higher patient morbidity, which refers to a patient having long-term diseases, illnesses, or health conditions, and can make it more costly to insure them. The data, covering 22 states and about 72% of Centene's marketplace membership, showed the risk adjustment payments Centene expected to receive would not be enough to cover the increased cost of care for the sicker population. Centene shares plunged 40%, dragging United Health down 5.7%, Elevance down 11.5%, and Molina down 22%. The shock triggered fraud probes and broad analyst downgrades as investors are now investigating insurance companies to measure their Medicaid/ACA marketplace exposure. On the fiscal policy front, President Trump signed the One Big Beautiful Bill Act into law on July 4th. The law makes the 2017 tax cuts permanent, adds $300 billion in defense/border spending, and includes $1.1 trillion in mandatory cuts. Key fiscal impacts include a $2.8 to $3.3 trillion increase in the deficit, $500 billion in Medicare cuts via PAYGO, and $793 billion in Medicaid cuts, all by 2034. PAYGO, or pay-as-you-go, is a federal budget rule requiring new legislation affecting taxes or mandatory spending does not increase the federal deficit. If a new law does increase the deficit, PAYGO mandates automatic across-the-board spending cuts. Because Medicare is not exempt from PAYGO, the deficit increase automatically triggers cuts to Medicare spending that are limited at 4% of the annual budget per year. The bill will also raise the debt ceiling by $5 trillion to $41.1 trillion, allowing the government to spend freely over the next 2 years without worrying about a shutdown. Looking across the Pacific, Trump secured a deal with Vietnam, imposing 20% tariffs on Vietnamese exports and a 40% rate on trans-shipped goods, which are goods developed in another country and just shipped through Vietnam to the US. US exports to Vietnam will be duty-free, though, for reference, the US imports roughly $140 billion from Vietnam each year and only exports $13 billion, leading to a trade deficit of roughly $127 billion. Since the US is the richest country in the world, it is completely normal for us to import our goods from cheaper countries, and since there is no country that looks at us like a cheaper option, we almost always run a trade deficit. We've spent so much time creating these US supply chains that we have the lowest possible price and get everything the most efficiently that any changes in these supply chains will increase prices. Regardless, the July 9th tariff deadline looms, with countries being forced to either finalize trade deals with the US or face tariffs between 10 and 70%. Japan may face 30 to 35% tariffs, up from 24%, while the EU is still negotiating. China operates under a temporary 55% tariff framework, and Canada re-entered talks after repealing its digital services tax. The risk of supply chain shock and higher prices continue to rise.